and the New York Stock Exchange own futures trading platforms, and very little open outcry trading takes place worldwide anymore. Okay? So you have the New York Stock Exchange, right? The NASDAQ, all right? And you have the OTC. That's all on the stocks. Okay, so if you want to trade Apple, that would be through the stocks. If you want to trade the indexes like the S&P 500, um, wheat, corn, soybeans, the index is on what's known as the CME. That's the exchange that you're going to go through. For wheat, corn, and soybeans, the exchange that you're going to go through is what's known as the CBOT. Okay. So they all have different exchanges of where you can buy and sell these commodities or indexes or stocks. Okay. Understand that they all have their own separate little things. All right. Where you're buying and selling through an exchange. Now, open outcry, because it was mentioned, and just so you get a little bit of history on this. So open outcry is the name of a method of communication between professionals on a stock exchange or futures exchange. Typically that was done on the trading floor. It involves shouting and the use of hand signals to transfer information primarily about buy and sell orders. Okay? That was the open outcry system. That doesn't happen anymore, and we all should count the stars above that people do not deal with our money anymore. Okay? Because those people on the floor were a bunch of scam artists who would literally trade against you. Trading against you still happens from brokers from time to time if you have a shady broker. But it's a much more fair system because everything is electronic. But open outcry, just know what it is. If you ever heard anyone say it or hear anyone in the future say it, that's what it was. It was an old method of doing hand signs in the pit. It usually looks like this over here to the right. You see this guy right here. He's hand signing to someone. Okay? It was very inefficient. I don't even know how things got done back then, but that's how they did it. And they would tell you, hey, I'm buying, this guy's trying to buy this. This guy's on the phone with a customer. This guy's trying to, I don't even know what he's doing back here. This guy's trying to yell, yo, pick me up some of those wheat contracts, for like 2.25 bid. Okay. So that's the way it was done before, but now you rarely ever see that. So futures contracts fluctuate in price just like shares of a stock. And the reason for changes in prices are the same principles of stocks trading. As market conditions change, the futures expected value of an underlying security changes and the price of the contract adjusts accordingly. A key fundamental difference between an equity security and a futures contract is the way in which the market determines price. An equity security is always priced on what the market believe it is worth today. Okay? A futures contract will always be priced based on what the market expects it to be worth in the future at expiration. We're going to talk about expiration. Okay? Understand that difference. So in the stock market world, when you're trading stocks, it's all about speculation of a company. In the futures market world, it's all about speculation of what that asset will be worth in the future. It is the same, but it's slightly different. Okay? In the futures market world, when you're not talking about like an index like the S&P 500, but you're talking about something like wheat, or you're talking about something like gold, or you're talking about something about oil, you need to understand that the laws of supply and demand weigh much heavier in those markets because it's an actual physical commodity. Okay? This is not speculation on, do I think this company is good? It's like, how much wheat is in the world? How much oil is in the world? Okay? And the prices are overall going, for those commodities, are overall going to be adjusted based on, there's no escaping those things. Okay? Do you see that difference though between a stock and like the futures market of trading a commodity? Okay? Remember, the futures market is just giving you access to be able to trade, buy and sell a commodity or an index, an entire index, whereas a stock is just really trading one company. All right. So if an asset is spot trading at some price, going back to the futures market, while rare, it is possible the market will expect a lower price in the future, and the futures contract price will imply a lower future expected value. What is a spot price? A spot price is the current market price at which an asset is bought or sold for immediate payment and delivery. It is differentiated from forward price and the futures price, which are prices at which an asset can be bought or sold for delivery in the future. Futures contracts that are physically delivered require that the holder to either produce a commodity or take delivery. If you're trading in the futures market and you buy oil, let's say, you buy one contract of oil, all right? If you don't sell out of that position, you can actually have physical oil delivered to your house. Okay? Keep that in mind. All right? That's a lot different than buying a stock. All right? So, if you're talking about commodities like oil, grains, etc., then be really careful. Your broker will definitely call you and say, "Listen, this contract is about to expire. You need to get out of your position because you may get delivery on that." Or they'll just sell you out beforehand. All right? So that's kind of the difference. And then the other differences between futures and stocks. Okay, futures, just so we're clear on this like language, like futures is just a contract that allows you to buy and sell, an index or a commodity or even a currency. Okay, it's just an instrument, it's an exchange that allows you to do all those things. Whereas the stock market, it just allows you to buy and sell stocks, period. Okay, and then ETFs were designed so that you could have exposure if you just wanted to trade stocks to a commodity. Although ETFs, I think, do a terrible job, and we'll get into that much later. But that's kind of the delineation between the two. Okay? So futures have what's known as leverage. And this is important to understand. Okay? Not leverage in terms of like if you trade them, you get like, if you had $100, the broker will give you $400 to play with. So that would be 4-to-1 leverage. Okay? Leverage is a little bit different for the futures market. But leverage, when used judicially, is a beautiful thing. Real estate is a great example of an investment in which leverage used smartly works well. It's rare to see a first-time home buyer purchase a house in the United States without the assistance of financing. This use of leverage has helped many people buy homes who would otherwise have not been included. More importantly, if purchased in the right market, the equity generated through the appreciation of a property enables the homeowner to move to a bigger home or another investment property. The media has deemed this the American dream, and it is made possible only by using leverage in a sensible manner outside of 2008. Okay? Now, understanding that metaphor of like how to buy a house, this is what's actually happening when you buy a futures contract. Okay? The futures market is very similar in that a trader has the benefit of 10-to-1 leverage on most contracts that trade on major exchanges. Similar to leverage in real estate, when traders buy a futures contract, a trader controls, and I put that in quotations, a sizable amount of the underlying cash asset. This could be an index, a currency, or a physical commodity for a small deposit referred to as a performance bond. This bond acts like as a collateral for controlling the asset. So we're going to go over this. So for futures contracts, so what this means for leverage is, and I think it will make more sense when we go into like how to understand like how these futures contracts are actually distinguished. But basically, you need to understand that when you buy a contract, so this is our little contract. So when you buy a contract like this, what happens is that you have to put up a certain amount of money. Okay, so if you buy an S&P contract, you have to, for one contract, you have to put up, let's say, $5,000. That doesn't mean that you're going to lose $5,000. What this means is that when you buy this one contract at $5,000, for $5,000. You give the exchange that $5,000. You own this one contract, okay? And this contract has an inherent point value, meaning for the S&P, it's $50. For oil, it's $10. So if the S&P moves up 1 point, you make $50. If it goes down 1 point, you lose $50. Now, and we'll get into more detail about that, but going over this in terms of leverages is, although you put up $5,000 to hold this contract, think of it like a Chuck E. Cheese token, if you will. If you do that, you actually control like $100,000. All right. Meaning you are just putting a small fraction of the money down to control this contract. But really, in reality, you are controlling like $100,000. And that's why it's called leverage. Okay. Does that make sense to everyone? This is generally where people will get lost. Okay. So now, if you buy a contract, you put up your $5,000, you own that contract, okay? But you're actually controlling $100,000. You're just paying a small fraction. This is leverage, not in terms of like a lot of stock traders are more familiar when they say leverage, they mean that their broker. So if they have a $5,000 account, their broker will give them like 4-to-1 leverage, meaning that they can trade actually $20,000. Only 4,000 of it is their actual money. In the futures market, everything is based on cash, okay? But the leverage, when people talk about leverage in the futures market, what they mean is that I'm buying this contract for $5,000. I'm putting up $5,000. The contract point value is not $5,000, but I'm actually controlling $100,000 worth of assets. Okay. Not that I'm losing this $5,000, but I'm just in reality, I'm controlling this amount of money. Okay. It doesn't mean anything in terms of trading, but you just need to understand that the leverage that people talk about in the stock market and the leverage that people talk about in the futures market are two separate things. And you need to understand that the futures market is completely and 100% cash based. So if you only had $4,000, you cannot buy a futures contract that's worth $5,000 because you have to put up $5,000 just to hold that contract. They won't allow you to do it. And this is a great thing about futures markets, I think, because it doesn't allow people to really kind of get in over their head because it's a completely cash-based business. Okay? So if you don't understand that, please type in a question because it's only going to get a little bit more complicated from here. And you need to just understand the difference between leverage in stocks, leverage in futures, the difference between a futures contract, and what buying a share of stock is. Okay. So let me look at the questions here. Alan, but that's not 10-to-1. I'm not understanding, like, you guys are just speaking in parables. So you need to, like, this is not leverage. Like I said, in the stock market, you don't have access to that leverage. All it's telling you is that you put up $5,000 and you're controlling $100,000. That doesn't mean that you can actually buy and sell $100,000. All right. Leverage in the stock market from a stockbroker, if they tell you they're going to give you leverage, all right, they're actually doing what's known as margin, okay? But they confuse the term leverage and margin. And what they're actually doing is allowing you to be able to trade 4 times your account size. The futures market doesn't allow you to do that. The contract, to hold that contract, this is what it's worth that you have to have in your account. But on, in the backwoods or what's going on behind the scenes is that you're actually controlling like this large amount of money. Okay. In theory, it has nothing to do with you actually trading. But I want you to understand that leverage, when it's talked about in the futures market, is much different than what leverage is talked about in the stock market. I don't want you guys to walk away with the impression that the futures market is this huge risky thing that gives you like, 100 to 1. It doesn't. All leverage is in the futures market is literally the fact that you are just controlling an asset that is worth $100,000 just by putting up 5,000, just like you would for a house. You put down 20% of your house. Okay. You don't own the rest of it. You have to pay the bank to get it. Okay. So you're leveraging yourself, saying, or you're leveraging the bank in this case, so that you are putting up X amount of money to hold the house, and you say, I will pay this amount to get to the the price of paying it off. In the futures market, you're just saying, I want to hold this contract that has a certain point value, which we're going to get into. Okay. But the exchange says, okay, well, if you want to hold that contract, we're just going to take $5,000 out of your account, and now you can hold that contract. That $5,000, though, in theory, is controlling an asset that's $100,000. Okay, just as an example. All right, you don't have access to trade $100,000. Does this make sense to everyone? Right, you're not owning any part of that $100,000. You're just putting up money to hold that contract. That's all you need to be concerned with. But I don't want you, because people try to, for me as a futures trader, people in the stock world look at futures markets and they hear the word leverage and they don't understand what's going on. And it's like, they're like, oh my God, they give you 100 to 1. Like, who would ever do that? No, that's not what's happening. Okay. It's just the sheer fact that when you put up this $5,000 for this one little baby futures contract, you are actually controlling, in theory, $100,000. That's all it means. It has nothing to do with you trading. The only thing you need to be concerned with is like, in order for me to hold this contract, I have to put up this amount of money, period. That's it. Okay. But don't get it twisted with the leverage that's implied in, most stock people talk about leverage, but what they really mean is margin. They just switch the terms, which is retarded, but they do that. And I want you to understand that the leverage that you get in like the Forex market or the stock market is leverage you can use. This is not leverage you can use. This is just leverage just because. So you just know, like, hey, on the back burner, this is what I'm controlling. That's it. So this is not leverage you can use, because the futures market makes it very difficult for people to overextend themselves because it's highly regulated. Okay. So meaning that it's transparent, it's clear, the bid and the ask, all that stuff, it's highly regulated, and their main purpose is really risk control. So if you want to buy a contract, you just have to put up this amount. That amount is technically controlling this huge amount of money, but you don't care about that because you're just interested in holding the contract. Okay? That's all I want you guys to take away from this. But I want you to also understand that leverage in the stock market and the Forex market is something, it means something completely different. And what they're talking about is margin. Okay? Literally. But they say leverage, and it's like, no, those are two separate terms. I can't fix the world's stupidity. Okay, I can't do it. All right, but I want you guys to understand leverage in the futures market is way different than leverage in the equities market. Okay, and what people mean. No, the maximum loss would not be $5,000, Marcus. So again, we're going to get into what that $5,000 per thing is worth, and it's going to make more sense, I think. But I just want you to understand distinguishing fact between leverage in the stock market versus leverage in the futures market. Leverage in the futures market is not the same. Okay? Leverage in the futures market is just telling you, yes, you put up this money, but you're actually controlling this amount of money. Whereas leverage in the stock market is more or less so allowing you to trade 4 times your account size. Okay? And remember that the futures market is all cash based. All right? So there cannot be a debt per se. They make it really difficult. All right. So now we're going to move through. So now we understand like what a futures contract is, which is basically a derivative. All right. It's a derivative that is just tracking something else. Okay. And the fact that to hold that futures contract, we have to put up X amount of money, which we'll get into. Okay. And we also talked about expiration. And this is where expiration comes in for like futures contracts. Okay. Yes, Alan, the concept and meaning is different. Okay. So they're called futures contracts. Why? Because people can buy and sell in the future. Okay. On a commodity or an index. All right. And because that exists, there's what is known as contract delivery months. All right. Now, this to get used to for a lot of people is really, really difficult. Okay. Because it doesn't make sense. To this day, I don't know why they ever did this. Okay. And as you see, this poor puppy's face down here, there's no easy way to remember this. There's no mnemonic I can teach you. There's no happy, joy, lucky song for you to remember, okay? But you need to be comfortable with this terminology. All right? So a futures contract has a physical delivery. Remember, if we're trading commodities, which is what most futures people do, okay, and the indexes, there is what's known as a delivery month. Now, an index doesn't have a real delivery, right? I mean, you're just buying on the index. There's nothing to deliver except money. You either lose money or you don't, right? But in the commodities world, some people buy futures contracts and take delivery, meaning they take the actual physical stuff. They take they buy it in the futures market. They wait till what's known as expiration, when that contract dies. All right. And then they actually just take in the oil or the gold bar or whatever. Okay. They can do that. All right. So the exchange had to come up with a way of what's known as delivery months for these futures contracts. So people can, in theory, buy and sell in the future. So they could buy. So for 2017, if I thought gold was going up for the rest of the year, I could buy a gold contract all the way out into December. Okay. And hold that until December, until it dies. Okay. Now, for most futures traders, though, who trade with a time horizon that's less than a month, which is me and probably is going to be most of you, we trade what's known as the forward month or the front month contract. Okay. Or in the olden days, this was called the top step contract. All right. So financial contracts traded on U.S. futures exchange, such as bonds, short-term interest rates, foreign exchange, U.S. stocks index, tend to expire quarterly, so every 4 months, in March, June, September, and December. For financial contracts traded for non-U.S. future exchanges, the expiration schedule may be not quarterly. So what all you need to know about this is when you see a futures contract, all right, you're going to see the designation. So GC, for example, is gold. All right. And then you're going to see one of these codes. Okay. So if the front month contract, meaning the one that we're trading, I think is Q, which is August. So if you see at GCQ17, all right, that's what's known as the front month contract. And that Q is basically just designated to August. Okay. If this contract is what's known as the front month because it's the one that's currently trading and has the most liquidity. Okay. I cannot go back in time and trade GCF 16. Why? Because the year 2016 is over. So you can see it at GCQ 17, which is the gold contract for August in 2017. But once that contract expires, GCQ 17 will never trade again. Okay, is this clear to everyone? Okay, just understand that this code right here is the month. And then at the end, you'll see either 1-7 or 7. If it's 2018, you're going to see 118 or 8. Okay, depending on how whoever you choose to be your broker does it. Okay, so with every contract, you're always going to see, just the main point of all of this is you're always going to see some designation of what you're trading, a contract month is the next thing. So you're going to see F, G, H, J, K, M, N, Q, U, V, X, or Z. And then you're going to see the year. Does that make sense to everyone? If it doesn't, please let me know. Okay. So that's how it's all laid out on a platform or a broker or a terminal. That's what it looks like. Okay. So that's all you need to know. And each of those little delivery months, like I said, you could buy further out. So the current contract for gold in this example is on Q. But let's say I didn't want to trade Q and I want to hold for the next 7 months, or in this case 4 months. I can't buy Q and hold forever like I could with the stock. So I would have to go out to the Z contract and type in GCZ17 and buy it there. Okay, there's inherent problems with doing that, but it's just for the sake of demonstration that if I wanted to hold longer term, I can, but I have to go out further. I can't just trade the current month contract. And every contract, whether it's gold, it's soybeans, it's wheat, they roll over. Okay. So what that means is that we go from the current month contract, which is Q, and then the rollover contract may be V or X or Z. Current month contract is what I always trade for them. I never really go on longer time horizons. And this is all set up on a calendar by the exchange. It will literally tell you this is what this current month contract is. The next contract rolls over on this date. And so if you wanted to trade on that specific date, on rollover or after, then you would need to be on that specific contract month. Okay. So is that clear to everyone? It just takes getting used to. Trading Bell says on TOS, the broker does the rollover for you. No. Like you'll still be bought and sold out. I'm not going to focus on TOS. TOS in terms of brokers and everything is not going to be, Thinkorswim is not going to be in any PowerPoint slide whatsoever. TOS is a rare exception, like Thinkorswim, in terms of what they do for futures, which is more convenient. You still need to know this stuff because there are no other platforms that allow for that. Okay. But I don't, like I said, Trading Bill, I don't want to confuse people. Like, you've been with me for a long time, so I know, like, you know this stuff. But the thing is like, you need to get used to understanding every designation, okay? So, like, the only thing you can come up with is, and I'll teach you guys something very simple, but basically you need to understand that if you're talking about metals, so metals like gold, silver, platinum, they roll over every 2 months. Okay, so if we're on GCQ, the next contract is most likely going to be V. And like I said, the exchanges and whatever platform you have will generally tell you, even Thinkorswim, what contract it should be. And they may not give you this code. They may just say October 2017. So if you typed in gold on your platform, you would see somewhere where on the contract it would say gold 2017. You say, okay. So then you would say, then you go to this table, you would look at, it would say, I'm sorry, October 2017. You would type in gold. It's going to say next to gold, October 2017. You'd come to this chart. You would look at it. You would say, okay. So we're currently on the front month contract, which is in October 2017. So that should be V. So I need to be trading GCV17. Okay. Your platform, if you have a good one, or your broker, or like I said, you can find all of this information on the CME website. It's going to tell you when contract rollover is happening and what contract you should be on. But if you use the platforms and brokers that I recommend, which we'll go over in the future dates, okay, they're going to always tell you. And the other thing that this is called, just for terminology's sake, so GC we know is gold. This is what's called a root, ROOT. Okay, so if you type in GC on any platform, it's going to pop up a chart generally, and it's going to show you that it's moving and doing its thing, and then it's going to have next to it, it's going to have, October, in our example, 2017. So it's always going to show you what the current front month contract or top step contract is. Okay. So there's no need to ever worry about, I don't know what contract I'm on, because first of all, it's your job as a trader to know what you should be trading. But the second part is that they make it really convenient. They're always trying to make sure that their customers know what the current contract is, not the futures, not the contract way out in December, okay, but what the current contract is, okay? So don't freak out about this, all right? It's really simple. It just takes getting used to, because stocks can, in theory, last forever, right? It's a company. Futures contracts roll over every month. Gold or oil rolls over every single month. So it goes through all of F, G, H, J, K, M, N, Q, U, V, X, Z. Metals roll over every 2 to 2.5 months. Okay. That includes gold, silver, platinum. And then indexes roll, as you can see right here, where it says financial contracts traded on futures exchanges tend to expire quarterly. What does quarterly mean? Every 4 months. Does that make sense to everyone? So just understand, you got a root, you got a code, and then you got the year. That's how it's all broken down. All right. If there's any confusion up to this point, please let me know. Eric asks, can you sell futures contracts before expiration date? Absolutely. That's what you would do. You're just trading the futures contract, just like you would a stock. You're buying it and selling it. You just have to remember what the front month is. Okay. So if you're trading August gold and it's set to expire on X date, just know that date, but if you want to trade gold for the next day or two, like, you're just going to use the front month contract. Okay. You're not locked into this. Okay. This is just like buying and selling stocks. All right. In terms of shares, like, you buy a contract, maybe you hold it for a day or two, you get out of the contract. Okay. But if you're going to trade, swing trade, anything less than 30 days, you know, then a good rule of thumb is you just want to make sure you're always trading on the front month, the current month contract. And like I said, that stuff will be designated inside either the platform, or you can just add it to like a Google Calendar of when rollover is and what current month contract you should be on. The root, again, is what designates the symbol. So we use gold, right? So gold is GC, okay? The S&P 500 for the mini contract, which I trade, is ES. These are all roots, okay? Then you're going to have a code that designates the front month. Okay, so currently in 2017, on July 1st, gold is Q. We're trading, the front month contract is Q17. In a month or two, it's gonna roll over. So then this Q would most likely become like either U or V. And then it's gonna be V17. All right. Does that make sense, David? But the root, you'll know these roots as you obviously trade them and study like what you want to look at, okay? And now that brings us into our next chart where you can actually see the roots from, this is actually taken from the CME website, okay? And this is also, we're going to learn how to calculate risk reward using this, okay? And this is, so you got to keep in mind all of these balls. You got leverage, you've got a code, you've got a root, and you've got a year. Okay? So the CME doesn't call this a root, it just calls it a symbol. Okay? That's right, Emily. So this is what this is the most important slide to bring all the stuff that we talked about futures together, okay? So the E-mini S&P 500, the root is ES, okay? So if I'm looking at the CME website, this is what I see. It says it tells me what the contract is. It's for the E-mini S&P 500 index. What is this going to track? It's going to track the S&P 500. If I look at this down here, okay, what is this going to track? This is going to track the NASDAQ. What is this YM symbol? What is this going to track? It's going to track the Dow Jones Industrial. Okay, because remember, these are derivatives. If I look at this, what is RJ going to do? It's going to track the Russell. Okay, what's the volatility index, so on and so forth. So hopefully this contract left side makes sense to you guys and gals. The symbol tells us this is the root. Okay, so if I go to my platform or my broker, if I type in ES, it should pull up a chart of all the data it has for the future symbol ES. That's the root. Okay, so does that make sense to everyone? Then what I have here is the exchange. This tells me what exchange it trades on. Okay, so CME, because this is a CME website, it's implied that it's going to be on CME's exchanges, which most things are, pretty much everything. Okay, but you see how it says GBLX right there? GBLX means global. All right, what does that mean? Or Globex. This is what we call it, Globex. Meaning it's open 23 hours a day. All right. And it opens up on Sunday at 6 p.m. Eastern Standard Time. If you notice the trading hours window, it tells you Sunday to Friday, Central Time, 5 p.m. to 4 p.m. What is that in Eastern Standard Time? 6 p.m. to 5 p.m. Okay? So when you see a designation of GBLX / the symbol, that tells me that this market is only closed for an hour. okay, between 5 and 6 p.m. The market technically trades from 6 p.m. until 5 p.m. the next day. All right, does that make sense to everyone? You with me so far? Cool. All right, now the next part of this little tear sheet is this is where we get into how much you have to put up and how much the value of that contract is worth if it goes up or down in your favor or against you. So for the E-mini S&P 500, it says $50 times the index. Okay? So this goes back to leverage. All right, what we talked about with leverage. So if the contract is worth $50, I would take this $50, multiply it by, we'll say the S&P is currently trading, the E-mini S&P 500 is currently trading at 2,421. Okay, that's what it's currently on Friday. It closed at. So if I took $50, multiply it by 2,421, the real net asset of what I'm controlling when I buy that contract, all right, is $121,000. So if I buy one S&P contract, the leverage that I am controlling is $121,000. All right. Do I have to put up $121,000 to trade this contract? No. To buy one contract, I have to put up $4,840. That's what it means by leverage, meaning I only have to put up this amount, but in theory, I'm controlling that $121,000. Do I care that I'm controlling $121,000? No. The difference is that I want you to understand that the leverage that we talk about in futures is way different than the leverage that we talk about in stocks. People use leverage in stocks crazy amounts, and that's why people blow up. You can't do that in futures, but your one little contract that you're holding that you only put up $4,840 for is literally controlling $121,000 in theory. But we don't care about any of that. But I just want you guys to understand the difference between the leverage in stocks and the leverage in futures, because I don't want people to like confuse you or tell you like, oh my God, futures are so risky. They're actually, in a lot of ways, in my opinion, not that there isn't risk, but they make it so you like, the exchange does something really well, which it's always trying to monitor risk, and it's trying to make sure people don't blow up by using crazy leverage. So they don't offer people leverage. They say, if you have this amount, you can trade this contract, period. That's it. You have this cash, you can have this one contract, period. So for me, I have like a $600,000 account. I would, for every $100,000, trade only one contract. So in my case, I would buy 6 contracts. So the amount of money I'd have to put up initially to hold those 6 contracts is 6 times 4,840. We'll just call it 5,000. All right. So I have to put up $30,000. Okay. To buy 6 contracts. All right. That immediately just gets taken from my account in terms of they're holding that money. Okay. So now that I have my little contracts, if I own one contract, the point value is $50. So if the S&P goes up by 1 point, so if it goes from 2,421 to 2,400, and I don't know why it keeps doing that. My bad. So if it goes up by 1 point from 2,421 to 2,422, okay, and I'm long, meaning I want the market to go up, then what's going to happen to me is I'm going to make $50. Okay? Now, you'll see something else that says tick value. All right, what does that mean? You see how it says 0.5 or 0.25 points? For each 0.25 points is $12.50. So how many 0.25 points does it take to make one? It takes 4, right? So 4 times 12.5 is $50. So what that means is the S&P, what this tells me is like this E-mini S&P trades in 0.25 increments. So between 24.21 and 24.22, literally between here are 4-point increments. So I could have 24.21.25, 24.21.50, and that's how it's going to get to 24.22. It's not, I mean, it can skip over if there's like a lot of people buying, okay? But it's always going to move in those 0.25 increments, okay? Does that make sense to everyone? Please tell me if it doesn't. Alan asks, can you lose more than what you put it up? Of course you can, Alan. So to take a $5,000 loss means the S&P 500 would have to move against you 100 points. Most people don't wait around for that. Okay. Does this all make sense? So you see how the leverage comes into this picture? We don't really care about that. I just want to make sure like you all are well equipped and smart enough to be like, you're a stupid stock trader. You don't know what you're talking about. Please do your homework. Okay, that's not what leverage is in the futures market. Okay? Because literally it doesn't take Einstein to figure out like the difference between the two. That's where do I get the point value of 2,421? That is because that's where it closed on Friday, David. I don't know if you heard me say that. Are there futures contracts that are derived from single stocks? No, there would be no point in that, right, Eric? Remember why futures exist. Futures exist to uh, allow people to trade an entire commodity or an entire index. Okay. If you just want to own the stock, then buy and sell the stock. Period. Okay. Yeah, but Alman, like I said, Alman says, it seems like leverage just increases your risk reward ratio in your favor in contracts. It doesn't increase the risk reward. It's efficient. It's efficient use of capital. Okay. So a lot of people in the stock market world, um, a lot of people in the stock market world tend to look at, oh, I put up this amount of money and I made this, right? Well, if you do that on futures contracts, I mean, in some of the trades that I've had, if I'm trading one contract, right? So let's say making $2,500 on the S&P 500, if you hold for 7 to 9 days, is not unreasonable, because in this example, we're putting up, let's say, $5,000 to hold the contract during the day and nighttime. Okay. And so I'm long one contract. Well, I only need the S&P to make $2,500 on one contract. I only need the S&P to move like 50 points. Okay. Now, the S&P on a daily basis moves 10 points. Okay. Either up or down. So that's like $500. All right. So, getting that 50 points is not unreasonable if you have a good strategy, and you hold a little bit. All right. So in theory, I've made 50% on the money that I put out. Okay. But that's really not how futures traders look at it. But if you want to do a side by side comparison of what you put out in terms of what you have to fork out for stocks and what you make versus what you put out to hold a futures contract and what you can make, it's a very efficient use of capital in my opinion. Okay? So that's always key. No, Eric, I mean, or I'm sorry. Let me go back up here real quick. Emily asked, could you talk more about maintenance here? Is this for holding the contract overnight? Yes. That $5,000, Emily, that you put up initially, um, the maintenance margin may fluctuate. Okay. Just like holding the contract can fluctuate. Sometimes it can go up, sometimes it can go down. And that's all based on like volatility expectations. You need to know that, like, in high volatile situations, they may increase the amount you have to put up to hold the contract. It will never be something like it goes from 5,000 to 10,000 in overnight or something. That's never happened that I've ever seen. But that's just to hold the contract for both. You just put it up, and that's just to hold it for both overnight and also for, during the day. Okay. David asked, so would I always look at the latest previous closing to see the point value? No, you would know because you're watching this thing trade every day usually, or at least you're taking on it like once a day. Okay, so you could just look at the close and you could see from the close of yesterday to the close of today, how much has it moved up or down, right? So then based on that, so if it moved 2 points, that would be $100. Now remember, there's that 0.25 thing in there, so you could have situations where and I'm just not going to make it 2,000, I'm just going to make it something simple. Okay, it's still the same thing. All right, but so like if you had some, remember it trades like this. So let's say it's at $10, I buy at $10. If the S&P ever traded that low before, that's never happened either. But it doesn't matter. My entry price could be 2,000. Okay, so if I buy one contract at at 2,000, or in this case 10, all right. So I'm at $0. So I'm long. And then the index goes up to 10.25, 10.50, okay, 10.75, and then 11. Okay, so from here to here, so from 10 to 11 there was all this stuff in between. So from here to here, that's 50. Each of these is 12.5, so on and so forth. Okay, so each of those ticks, that's what that's called. It moves in 0.25 tick increments. If you look at the Dow Jones Industrial, though, you'll see it moves in 1 point increments. Okay, so you could have it go from 10 to 11 and you would only make $5. Okay, there's no in between, it's just trades in 1 point increments. Whereas the Russell trades in 0.1 points. So every 0.1 point move is $5. If you have a 1 point move, then it's still $50. Does that make sense? Emily writes, all what is meant by day trading rate on some brokers margin. Sometimes you see, yeah, so what you would do with that is there are day trading quote unquote margins. So you would just take whatever this margin is, multiply it by 0.25, and that's what you'd have to put up for day margin. Okay, if you're going to day trade it. Day trading, by most day trading margin for all of the things that are offered by certain brokers, some brokers offer it, some don't. And when you see that, you would just take whatever the initial holding day for that margin is and then multiply it by 0.25%, deduct it, and that's what you have to put up. Okay? But you need to understand that they consider day trading, like between most of brokers I've seen that offer day trading margin on futures, uh, they determine it by 9:30 a.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. If you hold past that, you will be hit for that fee of 5,000. Okay? Alan says, thanks for simplifying and explaining with example. No problem. That's what I'm here to do. I just want to make sure you guys are all clear. That's all. That's just the settlement price by the exchange, Trading Bell.